Thanks for joining us today. We'll be getting started in just a few moments. If you can confirm you can hear us, type in what state you're coming from into the Q&A box, and then we'll get started momentarily. If you're just joining us, let us know that you can hear us by typing out what state you're from, okay? And then we will start in just a few moments with our webinar. So just let us know where you're from, please. All right, it looks like we have several students from several states. Thank you very much. Just please keep letting us know. And we'll be starting in a minute. Just as a reminder, if you raise your hand, we won't be able to respond. So what you'll want to do is type any questions you have into the Q&A box. Well, welcome everyone. Thank you for joining us for today's webinar. Just a little housekeeping before we get started. We will be running a live Q&A at the end of the webinar. So if you have any questions during the presentation, please type them into the Q&A in Zoom. If you miss anything, don't worry. We'll send you a link to the recording when it's available. My name is Amy Chamberlain. I'm an instructional designer at the CE Shop, the leading provider of online real estate education. Today, we are addressing federal financing regulations with Dr. Sam Martin from North Carolina. Sam comes to us with a tremendous amount of experience in real estate education and was recognized by the Association of Illinois Real Estate Educators in 2014. Sam is the owner of samthetutor.com. Now let's turn it over to Sam to get us started.
Hello, everybody. It's a pleasure to be here again, a pleasure to meet all of you virtually. Today, we're going to talk about understanding federal financing regulations. So we're going to have a brief poll to start us off. Then we'll have the main topic about understanding financing regulations, questions and answers section, and additional resources that we make available to you, and then we'll just wrap things up. So I look forward to this. It's always very, very interesting. I'll try to provide not just raw data, but I'll also try to provide the occasional test-taking tip. So you might want to take notes and make some screenshots if that is available to you, if you know how to do that kind of stuff. And without further ado, here is our first little poll. So how far along are you in our program? I'll give you a few more seconds to answer. And congratulations to everyone who is saying that they're almost done. I know it's a very long journey. I've been through many journeys like this. There seems to be no end to all the journeys. So let's take a look at this here. Oops. And it's a bunch of people, 41%, who are almost done. And welcome to everyone who is just getting started. So I am here to help. We are all here to help. So let's move on to the next little bit of business. There we go. This is a pie chart for the national part of the state exam. And you'll see some parts of it very, very, very small, but the parts we're primarily interested in, contracts, real estate practice, brokerage, things of that nature, that's like 30% of the national part of your exam, agency is also a critical part of your national test. Computation is what I think most of the testing agencies would call this. So math questions. But look at financing. That's a big chunk right there. So 17, 30, 43, 53, 63% of your test roughly will be in here. These 1, 2, 3, 4, 5 major categories. Not to say that you should just focus only on those subjects, but they are critical. If you fail this or this, if you fail any one of these, it drags your total cumulative score down so much, it's really difficult to recover. So if you don't do well here, no matter how well you do here, it's not going to be enough to pull you up and salvage your passing score. So today, we are going to talk about Truth in Lending and Regulation Z, the TILA RESPA Integrated Disclosures, one of my favorite abbreviations ever is TRID. And we'll talk about the CFPB, loan estimate form, the closing disclosure form, RESPA and RESPA's take on referrals and what's a legal referral, what's not, rebates and kickbacks and what is legal and what is not. Then we'll chit chat about the Equal Credit Opportunity Act, the ECOA, which is kind of like fair housing, except it's for fair lending. And then, again, one of my favorite topics, mortgage fraud and predatory lending. And just so you know, this is the tip of the iceberg type of a seminar. Each of these categories is a career. There are people who devote lives to each one of these things. Especially, I've helped different states investigate fraud and predatory lending. And let me tell you, there are people who devote many, many, many years to topics like this number 5 down here. But today, we are focusing mostly on 1, 2, and 3, and a little bit of 4. And now let's start asking you busybody questions about what you know. So what do you know? Well, the poll is about to open. There it goes. But before I start giving you the results of the poll, then how about a test-taking tip while you're answering this? Truth in Lending Act. Let's pretend you know nothing about this law. Absolutely nothing. What does it sound like? Does it sound like it would have anything to do with material defects? Probably not. Title defects? I don't think so. Environmental law? That's important, but I don't think it'd be in Truth in Lending. How about the true costs and terms associated with lending? I'm guessing, if I had to guess, that D is probably going to be the correct answer. So let's see. And most of you seem to be in agreement with me. So you're all using your critical thinking skills. So let's see. There we go. We're right. How about that? Most of us were right. It's the terms and costs associated with the loan. So let's move forward now. There we go. So first of all, let's chit chat about Truth in Lending and Regulation Z. Truth in Lending and Regulation Z, Truth in Lending, often known as TILA, T-I-L-A, Truth in Lending and Regulation Z are often considered to be synonymous. In tests, in books, almost always, it's TILA/Regulation Z. Normally, it's not really entirely synonymous. They're different things, slightly different things. Regulation Z often deals with implementation and enforcement, things of that nature. But for our purposes, we can basically just treat them as if they're about the same thing. And so Truth in Lending and Reg Z, TILA, was created to help ensure that consumers knew the true cost of lending. that borrowers understood if they went to Bank A and were presented with loan terms, they could then turn to Bank B, be presented with loan terms, and have a way of comparing the two products side by side in an equitable fashion. Otherwise, there's chaos, there's confusion, and borrowers really have no idea. Borrowers, you'll find, are pretty much like deer in headlights when it comes to trying to obtain a mortgage. They're counting on you as a kind of interface between them and a lender. Even though you're not going to be an expert in making loans, they still rely on you to help them try to figure some of these things out. Not like an expert, but like a trusted advisor, if you will. And so Truth in Lending and Reg Z, the federal government requires lenders to make certain disclosures so that borrowers can compare. They can comparison shop between one loan product and another. Most mortgage lenders have to follow TILA disclosure requirements. And Reg Z specifically applies to advertising, advertising credit. So in other words, ads have to be fair, they have to be accurate, they have to be honest, and if certain terms are revealed, it requires other terms to also be revealed. So how does this affect us? When you become a broker, how will this affect you in real life? I know you have to understand this so you can pass exams so that you can become a broker, but it goes way beyond that. It affects you in your personal life. When you ever want to borrow money, it affects the people you're working for when they have to borrow money. If you are an educated real estate professional, you add value to the entire experience. Buyers will want you. Buyers will want to work with you because you can explain things in a nice, simple, straightforward way across a kitchen counter or across from Zoom, whatever the requirements are at the time. You'll be able to understand and explain little things like an advisor would. So to that effect, in Regulation Z, we were talking about trigger terms. So let's take a look at what trigger terms are and how important they are. So which of the following statements is true regarding an ad that contains a triggering detail of a loan? Let's see. Everybody answer the poll. Don't make me come out there. I'll answer the poll myself if I have to. Everybody answer this poll. So in other words, we seem to be leaning towards all items must be disclosed, which I think is a really good answer. Let's take a look at this. And most of you are correct. The majority of you picked all items must be disclosed. But one of the choices was triggering details. Let's see. Triggering details are always illegal. Well, the triggering detail, the trigger term is what it is. It's a trigger term. It just means that if you say one part of the loan, you have to reveal all the other elements of it. So it's not bad, it's not good, it just is what it is. And so if you said only $5,000 down payment, that's a trigger term, you have to respond. The lender has to say what the other terms are. As long as the lender does that, then there's no big deal. It's just complying with federal law. When The problem arises is if they reveal a trigger term and they don't follow up. They don't reveal all the other terms. Then what they did was illegal. So this in and of itself is not illegal as long as you follow up properly in that ad. And by ad, I mean print advertising, television, radio, blog post, or a Facebook ad, wherever the advertising is located. So let's see. Which of the following statements requires full disclosure? Let's see what you think about this. A, this is interesting. And this is important for you because as a consumer, you'd like to know if a lender's trying to pull something shady on you, wouldn't you? And certainly representing a buyer, you'd like to be able to help them out too. It's interesting, an interesting split. Let's see what we have to say. Most of you said no down payment. And my reasoning on this is look at the word low. Low monthly, low down payment. That's very nebulous, isn't it? What I mean by low might not be low to you, right? Also, VA loan available, that just sounds like an ad. Like, oh, we have VA and FHA as well as conventional. So that doesn't strike me as being much of a trigger term. This does, though. This no down payment business. No down payment is quite a specific thing. Zero money down. $5,000 a month. Anything that's exact like that, only 360 payments, that those are normally trigger terms. You'll find in the future that those are normally trigger terms. And from my point of view, for you, it's really important to know examples of trigger terms because often on tests, which of the following is a trigger or a trigger term under Regulation Z? And they'll give you 4 examples, 4 choices. You have to pick out which one is a trigger term and which of the other 3 are not. So trigger terms, for example, you could have the amount of the down payment as a percentage, amount of any payment, number of payments, the period of time required to repay. Any of those things might be triggering events. Not a trigger term would be no down payment or APR. You would think the APR would be a trigger term, but the trigger terms, APR is not a trigger term because it has all the information in it that you need that all other terms would combine together and form. In other words, APR, if I said the APR is 4%, that tells you the interest rate, it tells you the other costs of borrowing, it refers to the length of time, it refers to many, many other aspects of the mortgage. So APR in and of itself is not a trigger term. And just saying that this interest rate is 0.5% below our normal, that's, what does that mean? What is your normal interest rate? Or nebulous things like easy monthly payments, flexible financing. Again, those are not trigger terms because they're just so loose as a goose. They're not giving specific numbers. So now, we've talked about TILA a little bit, the Truth in Lending Act, and we're about to talk about RESPA very soon, the Real Estate Settlement Procedures Act. But the CFPB, a relatively new government agency, they were mandated by another federal law that we're not talking about today. Thank you very much. But the CFPB was willed into existence by the federal government, and they're responsible for the TILA RESPA, integrated disclosures, everyone's favorite TRID. So under TRID, there are various disclosures that have to be made. So what we need to know as prospective brokers, there is a loan estimate that's more on the TILA side of things under TRID. A loan estimate form, it's a federal form. All lenders have copies of it and they fill out the loan estimate. The borrower has to get the loan estimate within 3 business days after they make their application. For our purposes, a business day is the same thing as a banking day. If you could see either one, they pretty much mean the same thing. Anytime, and here's another test taking tip, anytime that you see an example, and that example is talking about depositing money or a disclosure that a bank has to make, if it involves a lender, chances are pretty good that the time period is going to be banking days or business days, probably not calendar days. Just a general rule of thumb that I've noticed over the years. And so there is a specific definition of what a loan application is. There's 6 items that a loan application has to have in order to be called a loan application. And the loan application is kind of a trigger. Loan application doesn't even have to be on a specific form. It can be on a napkin from a restaurant. As long as those 6 items are on that form, then it is an application. And the lender has to get the LE in the hands of that borrower within 3 banking days. Until the applicant gets the LE, the lender can't even charge them anything except for a credit report. So 30, 40, 50 bucks for a credit report, and that's all, just to run their credit. Also, when the borrower gets their loan LE, the loan estimate, then they also get a home loan toolkit booklet that the lender has to provide. The broker does not provide these things. The lender does not send these things to the broker. The lender gives these things to the borrower directly. The reason this is important is because the loan estimate is going to tell the borrower very important information about their loan. The interest rate, the terms, fixed or adjustable, is there a prepayment penalty or not? All kinds of juicy information. Later, 3 business days before the closing, then the lender has to give a closing disclosure form to the borrower. Well, this is kind of sort of related to the RESPA side of things. This closing disclosure replaces the old HUD-1 settlement form, which is gone now. So the closing disclosure is compared against the loan estimate. The term should be identical. A little variation is allowed, but not too much, and only in certain places would differences be allowed between the loan estimate and the closing disclosure. So the timing is critical because often tests expect you to remember loan estimate, 3 business or banking days after application. Borrower's closing disclosure, 3 business days before the closing. And a question, which of the following activities violates RESPA requirements? Oh no, not a violation. So I'll give you a minute to read through all of this. Answer, answer, answer. A licensee sends a gift basket. That doesn't sound bad. A loan officer sends baseball tickets. If only I knew anyone sending me baseball tickets. I've never had anyone do that. A licensee and loan officer decide to have dinner after the closing. Split the bill. What a cheapskate. A loan officer receives a thank you card from a licensee. Not even a fruit basket? What a cheapskate. So let's take a look and see what we've got here. So, loan officer sends baseball tickets, a thing of value. What a concept. I suspect we're on the right path here. And there we go. Very good, very good. So a loan officer sending a thing of value. A thing of value could be cash, could be an automobile, could be my little stuffed owl here. My grandkids named him Owly, so it could be anything like that. So very good, very good. Everybody doing very well. Good job. RESPA. We talked briefly about RESPA just a few minutes ago. RESPA, the Real Estate Settlement Procedures Act, it covers things like referrals and rebates. So you probably have already heard that sometimes one real estate agent will refer a client to another real estate agent, and you can pick up a referral fee for having done that. That normally has to be from licensee to licensee. Actually, if I know someone who wants to buy a house in another state, my firm makes a connection with a firm in that other state, and it's firm to firm. And when that buyer buys a house in that other state, a commission is generated there, paid to that firm. That firm sends a part of the commission to my firm, and my firm splits with me. That's technically how this works. But is RESPA upset with that type of relationship? No. One real estate agency and another, they can make arrangements to help each other and split a commission, a referral fee. That's perfectly all right. It's not so cool if you're working with a settlement service provider, like a title company, home inspector, appraiser, people who provide services for settlements. Well, I'm a broker. I refer one of my buyers to a home inspector. The home inspector is so appreciative. They say, Dr. Sam, if you just give me 4 more referrals like this, I'll do a home inspection for you for free. Does that sound like it would be a really good idea or a very, very, very bad and illegal idea? You never guess which way I'm leaning on this whole subject. So that would be an example of an illegal referral. And rebates, well, rebate could be a discount. I send a borrower over to a title insurance company. That buyer, they buy their title insurance through that company, and then I start getting discounts and rebates from that company. These are all kickbacks, rebates, illegal referrals, things that we're not supposed to be doing. So, what is the Equal Credit Opportunity Act, the ECOA? How about this question? Under ECOA valuations rule, a lender has blankety blank from the date of receiving the loan app to notify applicants of their right to receive a copy of appraisals. You'll notice there are some questions here that talk about time periods, right? 3 days, 24 hours, 3 calendar days. If I were you, I would make a spreadsheet. One spreadsheet, doesn't have to be fancy. It could be just a piece of paper, or it could be Excel, whatever you want to do, whatever makes you feel more comfortable. And on that spreadsheet, I would put the name of the law, the time period, the page number where you found it. For example, under ECOA valuations rule, a lender has 3 business days from the date of the loan app to notify applicants of their right to receive a copy of appraisals. Isn't this just one deadline among 1,000 that you have to know? But you could always look them up again. You have a book or some content similar to this. It's either online content or a book of some sort. You've got some subject material. Just flip through it and find it, right? How hard could it be? Or you could already have it down on 3 or 4 pieces of paper. And when you need any deadline, all deadlines are going to change state by state, unless it's a federal deadline like this one. Well, just flip through 3 or 4 pages and you'll find it, because it'll be right there. You already wrote it down for convenience. It'll be hanging out there, right there, ready to go. So another happy little test taking tip. And most of us seem to get that one right too. You're a smart bunch. My goodness, 3 business days. I can't fool any of you. Now, one of my favorite topics ever, mortgage fraud and predatory lending. Fraud. There are 2 basic types: fraud for profit, fraud for property. Fraud for property is defrauding someone to cheat them out of their home or whatever real estate they own. Fraud for profit is pernicious. It's much more difficult to try to track down and potentially much more harmful. It is fraud for profit. You're cheating a few people, a bunch of people, with your habits, with your behavior, trying to make money off of all of them illegally. So basically, where real estate brokers come involved, you either have fraud that you either have negligence, which means you're kind of an idiot and you didn't know what you were supposed to do, but you did it anyway, or fraud. So you're either negligent or you're committing fraud. You're lying, you're cheating, you're misrepresenting, you're omitting things. All bad. So negligence is you didn't do what you were supposed to do. Like I said, you're an idiot. But fraud, you're deliberately lying. You're deliberately misleading people in order to make money off of them. So it's a bad day in court when you're trying to convince a judge that you were only negligent and not trying to commit fraud. That's a very, very bad day for you. Anyway, there are 6 basic types of mortgage fraud. And in my travels, I've had the ability to see 1, 2, 3, 4, 5. I've seen 5 out of the 6 that I can remember anyway. So illegal property flipping. Who here watches HGTV? And when you watch HGTV, aren't there people on there who like to flip? They buy a house, fix it up, sell it. Nothing wrong. Absolutely nothing wrong with that. It's illegal property flipping if you commit fraud along the way. So illegal flipping is, I sell my house to you, you don't do anything to it, and you sell it again, maybe even back to me at a higher price. I sell it back to you, you sell it back to me. Each time we're inflating the price artificially, and we have an appraiser in our pocket. Oh, by the way, if you'd like to know how much extra an appraiser makes on appraisals where they're committing fraud, that's about $200 or $300 extra over and above their normal fee. That's the cost to buy an unethical appraiser these days, in case you were wondering. So the appraiser going along with the deal and lying, everybody lying. There was one fraud ring in Illinois that had roughly 10 or 12 people in it. So they involved a few of these principles in their fraud operation. It was quite a sophisticated deal. How they were broken, a straw buyer, which we'll talk about in a moment, a fake buyer, went to her clergyman and realized she was doing something wrong. She asked what she should do, and the clergyman just told her to follow her heart. And she followed her heart to the FBI. And they had committed fraud that we know of in 80 different cases. And let me just say, when fraudulent transactions hit the market, they're in the multiple listing service. How would that affect your CMA or BPO if there were fraudulent comparable sales in your database? So this reaches many different corners of real estate. It really does. So inflated appraisals, that goes hand in hand with this illegal flipping. A silent second, you present as a buyer putting 20% down. After the closing, everybody else leaves. The seller reimburses you your 20% down and takes back a second mortgage. It's essentially a no money down deal that involves mortgage fraud. So that's an illegal second mortgage that the primary lender doesn't know anything about or shouldn't know anything about, according to the buyer and seller. A straw buyer is a fake buyer. They steal someone's identity in Minnesota and use that person's identity in Illinois. They go to the DMV, get a fake driver's license. The fake buyer goes up to an employee of the DMV. It costs about $500 to buy an employee at the DMV. Not all of them, just that one, the one who needs money the most. They find them and they make a picture of the fake buyer and put the Minnesota person's name on the driver's license. At the closing, they showed the driver's license. Here it is. Fake buyer's face, person's identity from Minnesota, straw buyer. And of course, that's fraud. And equity skimming, an investor is receiving title to a property, often using a straw buyer, and they don't make mortgage payments. They rent out the place until the bank takes it away. And if you know how to play the system, you can spend months or years in court, dragging the foreclosure process out as long as humanly possible. And they might have stolen someone's identity from another state entirely in order to obtain this house. And false identity. That's where you're stealing the person's identity from Minnesota or someplace and using it fraudulently. So, red flags. Let's answer this little question. Which of the following would be a red flag for you, especially if you're a real estate broker? A red flag of fraud. We'll address the question of why you should care in just a minute. But first, let's just answer this. What would be a clear-cut red flag? They're all interesting. I'll give you another few seconds. Fraud's always been one of the most interesting subjects in real estate to me, mostly because the people doing it just assume they're never going to get caught. It's just astonishing. They're literally baffled when they get caught. As the FBI is processing them, they just can't believe, they don't even see it as having done something wrong sometimes. So let's see. Very good. Very good. And so it is true. Most of you are right. An investor purchases a property and quickly sells it at a higher appraised value. Is that always an issue? No. People buy low and sell high and make a good return on their investment, and that's perfectly fine, as long as you're not doing some of those other things we were talking about, like using straw buyers and other types of red flags. As long as they're not doing anything wrong, there's nothing wrong with answer A. There really isn't. So let's see now. Other red flags, potential red flags. Well, we've got large adjustments, like in the sales comparison approach of an appraisal or your CMA. Large adjustments, I can tell you right now, added to this would be an appraiser pulling comparable sales from entirely different neighborhoods, maybe years ago. Is it possible that the market, let's say 5 years ago, was booming, property values high? Now it's flat, property values lower. The appraiser goes back 5 years to find comps from the boom time, from the good old days when property values were high. So that's a red flag. As an appraisal reviewer, I would always be on the lookout. I've actually seen fraud in appraisal reviews I have performed. And I notify the client and call up the state licensing agency, because they always have an interest in things like this. If the buyer requests a particular appraiser, that largely has been eliminated nowadays, because now federal law dictates that appraisal management companies be used, an AMC. So the borrower makes the application, the lender puts an order in with the AMC chooses the appraiser. So it's an extra added layer to help prevent bias. Let's just put it that way. And actually, I have been offered bribes 3 times in my career as an appraiser. Very interesting. And the only reaction I could think of was, no, please put that money away. I would never accept money from anyone except my client, because I was expecting 60 Minutes to be there with a camera crew. And how long have you been accepting bribes, Dr. Martin? No, never. I never accept bribes. And that gets me to this point. Why do you care about these red flags? As a broker, why would you care? Because isn't your reputation tied up with the people with whom you're working? If you have a buyer and they're committing fraud, The feds aren't just going to look at your buyer. They're going to look at you. They'll assume you were in the fraud ring. They will, until you can exonerate yourself. I want to find out early on, don't you, that there are some problems here that maybe you should be addressing, something to pay attention to. And let's see. Predatory lending. Predatory lending, which of the following best describes predatory lending? What do we think? Very good, very good. I'll give you a couple more seconds. I think you're all on the right track, though. How about this? Predatory lending, one category of it, making loans to unqualified borrowers. If there's a high-risk loan, you expect that a lender will disclose their higher fees for a riskier loan for the lender, or they will charge a higher interest rate. For someone who's got a FICO score of 450, that person can expect to get a higher interest rate. And refusing to approve small loans to overqualified buyers, don't understand the logic, but it's not predatory by its nature. So very good, good work. And which of the following is a true statement regarding usury laws? Usury, and if the interest rate is illegal under usury laws, we say that interest rate is usurious, which is a cool word to use at your next party. At your next birthday party, just start saying usurious. People will think you're so smart. Or they will stop inviting you to parties. I always wondered why that happened. Have to be more careful using the word usurious, I guess. So let's see. Very nice. So far, so good. And lending money at excessively high rates, illegal rates, rates that exceed usury laws for that state. And how should a licensee proceed if they observe a red flag related to mortgage fraud? What should you do? Call Ghostbusters. That's what I say. Once had a friend who was almost arrested for appraisal fraud, let me tell you. That was a sobering experience for him. And very good, everybody. So you could call the police, I suppose. You could call the licensing department. You could proceed with the transaction, but I don't think that's such a good idea. Do you? Really? The commission is nice, but really? You want to draw that kind of attention to you? You want to get that type of reputation? And so bring it to your broker's attention. Absolutely, bring it to your broker's attention. Talk to them about it. And this affords the opportunity to find out more about your broker, doesn't it? What is their reaction? If they just dismiss it out of hand and say, wow, it's not your problem. Why are you even bringing this up? Just go on with the deal. Let's make our commissions and then work on the next deal. That's who you want it to work for? Really? That's your boss? And so start here, then maybe proceed here and here at that point. So very good, everybody. Bring it to the broker's attention. Oh, there we go. And I think we are getting close to the end. Just as a quick reminder, there will be experimental questions on your test. You don't know which is which. 5 or 10 on your test, they don't count for you or against you. Don't try to guess which is which. However, a little birdie told me, when you're on a question that doesn't count, sometimes your timer might stop because they don't want time to tick off while you're answering a question that doesn't count. That's something you might look out for if you have the presence of mind to do it. When I take tests, I just try to get them all right. That's all there is. I don't like to play these little games. But anyway, just know there are some questions out there that don't count. And please check with your candidate guide. It has many, many, many valuable bits of information about the test you're going to take. I would figure out how many questions I need to get right. I would figure out how much time they're giving me and how many total questions there are. I want to know how many minutes per question I am being given. I need to have time management. I have to keep ticking, keep going. If I have 100 questions and I have 200 minutes, that's 2 minutes per question. It helps keep me on track. So I think that's about it for me. Does anyone have any questions?
Yeah, thank you so much, Sam, for
you.
sharing some great information with us. And we will take time for questions now. Just a reminder, please be sure to type your questions into the Q&A in your control panel. And it looks like we have a few already, so keep them coming. Could you please, Sam, cover the trigger terms again and address whether or not no down payment, in quotes, is a trigger term?
No problem. So trigger terms, let me see. Your best bet is to look into your content, whatever content you've been given, make a short list of what trigger terms are or aren't. You can use the PowerPoint here if you prefer to do that, but you need to check your content to get examples. The most important thing is if we gave you a sample ad and it has 5 or 6 items in it, is one of those a trigger term? And were all the terms therefore revealed? And so specific things like $1,000 a month payment, or saying low down payment or small down payment is not a trigger term. It's my understanding, and I'll have to look this up just to be on the safe side, but if you say no down payment, it's pretty much the same as saying 0 down. It sounds pretty specific to me. So my initial gut instinct is it might be a trigger term, but I would have to look that up and get back to you. So I hope that helps.
Hi, Sam, it's Jill. Can I talk for just a sec?
Sure.
Thank you. So while you were presenting, I was looking it up for you.
Hooray.
So you don't have to. No down payment. No down payment is not a trigger term. Not
Hooray.
a trigger term.
Thank you.
So we are good on that. Now we've got like only 13 more questions or so. So I'll
Next, what's the next question? I'm ready for you.
Excellent. Okay. We have one that says, can you explain again why the APR rate does count as a trigger term?
APR is not a trigger term. My understanding is it's not a trigger term because APR, if I say APR is 5%, it has a lot of juicy information just in that one number by itself. But other things like interest rate, which is not APR. Interest rate would be a trigger term. Loan is 360 months. That's a trigger term. Those things would be trigger terms.
Okay, I have another question here. Thank you. What other regulations besides Regulation Z will we be tested on?
everything. So Regulation Z, Antilla, RESPA, TRID, because TRID kind of is an amalgam of TILA and RESPA, Equal Credit Opportunity Act, and in addition to those, on the state level, which we didn't talk about today at all, for obvious reasons, because you're all from different states, you have to bone up on your individual state to find out exactly what state laws there might be affecting you. But those are the big ones. The big ones that we talked about today, at least. They're the ones that are really major, I think.
I have another question here that I think I know what your answer is. How much of what you went over is potentially going to be on the exam?
A question I almost never get. I'm surprised. Practically everything I talked about could be on a test. Literally every word could be on some test, either your final exam or the state exam. I'd be astonished if things that I talked about here weren't on your test, especially the big time federal laws, the TILA, RESPA, TRID, 3 days, all these different time periods, they're all testable. So sorry, I wish I could tell you, nope, you don't have to worry about that thing. That never happens.
So it looks like a couple of our listeners had a question about, under RESPA, is there a monetary maximum amount? So for example, why is the gift basket okay, but the baseball tickets were not okay?
The gift basket is considered as I recall, it was a gift basket from whom to whom? Was it a broker to a client, if I'm not mistaken? Because I can't remember the exact example.
Yes,
I think so.
But if it's a
yes,
gift,
it was, Sam.
gifts to clients are allowed. It's like a thank you card or a gift basket or a fruit basket. But from a settlement service provider to one of us, that's illegal. That's a kickback of some sort. So the difference is, are we gifting a client or are they gifting us? If they give money to us, it's like a bonus, and your state law dictates how that can happen. But many states allow that type of extra bonus. In North Carolina, for example, which is a place I know near and dear to me, client can give us a bonus, but lenders have to approve, the brokers in charge have to approve, everybody has to approve the bonus. And it's considered income, so it has to be reported on someone's 1099 or their income tax somehow. So the question is it from us to a client or a client to us? Beyond that, is a settlement service provider involved? That is the tricky issue. So if a home inspector is giving me something of value, a baseball ticket, probably that's not going to be looked upon favorably then, is what I'm thinking. So, any more?
Okay, thank you. Thank you. It looks like we have covered all of our questions. So, Sam, is there anything else you would like to cover before we wrap up?
The one thing I'd like to cover, aside from do not commit fraud, in your notes, write down right now, no fraud, stop committing fraud right now. Aside from that, the test taking tips I gave you are real and have helped students for years. So any, like making the spreadsheet of deadlines and such, that's something that often no one ever tells you to do. It's what I tell all of my students to do on day one of their course. Start making the spreadsheet, write down all the time periods. You have 7 days to do this, 3 days to do that. It's nerve-wracking trying to remember it all. And it's just terrible trying to look it all up after the fact. It's on page 392, where is that? Where is this number? So that's the big takeaway as far as test taking tips goes. So I hope that helped. I hope you all had a good time. I had a good time.
Great, Sam. Thank you, everyone. We appreciate you being here.
Sam, Amy, I hate to interrupt you. This is Jill. We do have one more question that I don't think has been addressed yet. And that was when we were discussing the straw man or the nominee loan.
Hmm.
And we just have a question asking for another example of that, just to get that solid, what that is
Sure.
exactly.
Thanks, Jill.
I would say straw buyer. There was a case, literally a case with a fraud ring in Chicago. They had already done about 60 or 70 fraudulent transactions. They would steal someone's identity, literally in Minnesota. That's where I got the state Minnesota from. And they would take that person's identity and essentially glue it onto a fake buyer. They would pay the buyer $5,000 to pretend to be that other person in Minnesota. Then they would find a seller, pay them $5,000 to go along with the fraud. The house would be in deplorable condition, probably worth $15,000 or $20,000 at most on a good day, and be ready essentially to fall down. And they have an appraisal done. They apply for a loan. One party I talked to was the mortgage lender. He was a broker in that mortgage lending company, and he would take these straw buyers and fill out their applications for them and fill in the blanks of the application with the information that was stolen from the buyer in Minnesota, from the innocent person in Minnesota. And he would get a couple $1,000s per deal for filling out the forms, essentially. And he did 3.5 years in a federal penitentiary for that role right there. Well, ultimately, they have a closing. The appraisal comes in way inflated. In one case, this fraud ring took Hollywood set windows, fake windows, and put them in the house because the house itself had no windows. And the appraiser had to take a picture of the house to make it look all pretty. The appraiser never went inside the house because there were no floors in this house. But the appraiser said there were floors. The appraiser said the place had just been rehabbed and had a value of $150,000, when in fact it probably had a value of about $15,000 or $20,000 at most. So right after the appraiser left, they pulled all these windows out of the house so they could use them in another house where they were committing fraud. The buyer goes to the closing, presents a fake ID from the driver's license from the DMV. The notary checks the identity, and there's Sarah Smith, and that's her face, so must be the borrower. And they borrow full value, 100% from FHA, from the lender, using FHA insurance. Then they give $5,000 to the seller, $5,000 to the buyer, and the fraud ring walks away with the rest. So that's clearly an example of the straw buyer, a straw seller, straw everybody, everybody's straw. 2 brokers went to jail, 2 appraisers went to jail. The buyer, who I said got religion at the last minute and turned in everyone else, made a plea deal. That was one of the advantages of being the first one to turn over on everyone else. So she didn't go to jail, but everybody else went to jail. Lots of people going to jail in this case. So that is literally an example of a straw buyer, and the mortgage broker who went to jail developed cancer in jail and had to get cancer treatments in jail because they don't release you just because you have cancer. So a really happy story all the way around. Moral of the story is don't commit fraud. Fraud, very bad. Bad fraud. I hope that helped.
That's an amazing story. And I think those stories help us to see exactly what these terms mean. So I thought it was great. I've got another question here. What if a client wants extra advertising? Is that okay to pay for that?
It's okay to pay for extra advertising. Like a seller wants more, they want a beefed up ad campaign. Not only can you pay for it if you want to, But can't you ask the seller for an increased budget? If the house is, let's say it's residential, let's say the house is like a 10,000 square foot house and it's going to require a lot of marketing, you know you're going to spend $5,000 or more marketing this property. Ask the seller. It's their house. You want to do the best job you possibly can. You want to put ads all over the place. You want an airplane flying overhead with a banner behind it. You want lots of internet advertising. You want a billboard. You want all kinds of bells and whistles. Ask the seller, and they might chip in. They might be willing to chip in some or all of your advertising budget. That's always a possibility. Any more questions?
Yes, this one refers back to the story you just told. What happened to the person who had their identity stolen in the first place?
You know, that's the odd thing. I never did find out. Not about that specific lady who had her identity stolen, but I know generically, overall, what happens. Someone's identity is stolen, and first you have to try to convince everybody that your identity was stolen and that you're not the lady who borrowed $150,000 in Chicago. Can you imagine being that lady in Minnesota and she gets an invoice from a mortgage company for a $1,500 a month mortgage payment? Harry, did you buy a house in Chicago? Because they know nothing about it. The first they heard of it was this. And of course, no payments are ever going to be made on that. So her FICO score takes a nosedive because everybody assumes it's her. The poor innocent, buyer in Minnesota. That takes about 2 years, minimum 2 years to straighten that out. In the meantime, your financial life is on hold while you're trying to straighten all that out. I've talked to appraisers who have had their identity stolen, where people were using their name, their signature on fraudulent appraisals. Identity theft is absolutely, it's like wildfire. It's just huge right now. So, any other questions?
I think we've covered them all.
Hooray!
Yeah. So thank you so much, everyone, for being here today. We're glad you're here. I'd like to thank Sam for joining us. Your knowledge, expertise, and willingness to share it with our student community is greatly appreciated. And everyone, please look for an email from us with a link to this webinar recording. And also keep an eye out for invitations to additional webinars in the near future. At the conclusion of this webinar, you'll be invited to complete a survey. If you can take a minute, we would love your feedback so we can continue to provide valuable webinars to you. Thanks again for joining us today, and we will see you next time.
Thank you very much.